Welcome back to Open House with Mark Siwiec and Corey James Moran, brought to you by Elysian Homes by Mark Siwiec and Associates, a greater Rochester real estate podcast. This is episode 169. Mark, how are you?
I am good, bud. How you doing?
I'm doing well. I've got a new job. I don't know if you know this or not.
You're a delivery man?
I am a delivery man now.
Yes, exactly.
We are in the midst of what we call pie season here on the team. So how many are we delivering? 2,000?
Yeah, 2,000. In large part because of the efforts of our guests who we're going to introduce in a few minutes, and our good friends over at Genesee Regional Bank. So,
absolutely.
Yeah,
but it is always heartwarming to get the texts from clients, the follow-up of thank you so much for the pie. And it's a nice gesture, but it's not like an overly grand gesture, but people take it so to heart. It's phenomenal.
I began to realize a few years ago that so many of the recipients of these pies are realizing that it's something more than just the $8 pie. It's more than flour, shortening, and fruit filling. Instead, people realize that it's just the gesture. And it's just the mere fact that we're recognizing them for the role they've played in terms of the growth of our business. So it really, I actually don't deliver many pies because my phone, the text messages, the emails that come in over this 10-day period of time are just so overwhelming that I just really have to spend all of my time just keeping up on top of all the correspondence. It's really great.
It's like your birthday every day.
Yes.
During pie season.
Yes, it is. Yes. It's
and shout out to our entire team who does all of the delivering, do all the delivering ourselves, which is it's a big task.
In particular, who is just overseeing the whole process.
Our pie czar.
Yes, our pie czar. Yeah, exactly. You're doing well?
Yeah, doing great. It's busier than expected, to be honest.
Good. That's really good.
Is it? No, it is. It definitely is.
Well, it's good for a few more days, but come on, let's face it.
True.
We all want to enjoy turkey and gravy next week.
So it's coming. It is coming. Let's get into the market update before we get to our guest. In terms of single-family active listings right now, just a very slight decline. We had 460 in Monroe County last week. We're at 456 right now.
Okay.
6 county region, 837 last week. We're down just 2 to 835 right now. Properties under contract and pending, we're at 1044. That's down from 1086 last week. And then for the 6 county region, we're at 1627 last week. We're at 1565. So again, everything's starting to trend down a little bit.
Just a little bit, but not as much as we would have expected.
No, you would think, again, it should be almost nothing at this point.
Right, yeah.
And you've got to wonder, why is that? I think we chatted about it last week. Post-election, I think there were many people that were waiting to see what was going to happen. And now, they want to test the market and see. And I've heard across the spectrum, a property that was purchased a couple of years ago for $100,000. I've got an investor right now who's interested. They listed it for $100,000. Obviously, since then it's appreciated. Didn't get any, or got one offer that wasn't enough. Then I hear about a property in Penfield that was listed at $179, needed considerable work, had 29 offers, and ended up going for like $275, $279.
Unbelievable.
So you're seeing it's very hit or miss right now in the market.
Yeah, it really is. Yeah. I've actually heard of 2 clients. I hate to say it, but 2 clients, both of whom are selling their property off market to buyers who approach them. Now, first and foremost, we support our clients in this, but both of them, I swear to God, they would have put more money into their pocket if we had just been allowed the privilege of putting the house on the market for sale for 4 days, creating a bidding war, and then ultimately they get to choose. They either get to stay with the offer that they had,
sure,
or if we're able to get them more money, exclusive or minus the commission that is due us, I think that both of them would have done much better. But that being said, it's their choice and we support them and whatever. Yeah. So
it's what it is.
Yeah. It's what it is.
Really quick mortgage rate update before we get to our guest.
What a perfect segue this is going to be. Oh my God.
Absolutely.
Kind of nervous.
Yeah, don't be nervous. You're fine. We were at 7.01 last week. We're now at 7.04, just kind of hovering around the same spot for the 30-year. For the 15-year, it was 6.37 last week. We're at 6.42 right now.
Okay.
So let's bring our guest in, the Genesee Regional Bank Group Vice President, Residential Mortgage Manager, Joe Leone. Joe, how are you today?
I'm great. How are you guys?
What's going on with rates? Why? That's might be a question.
I did leave my crystal ball back at the office. However, when I did look in it yesterday, I think we're going to be here for a little while, right? And I think, as much as we've seen leading up to the election and now post-election, right, volatility seems like it's going to be here to stay. We have some obviously world events going on as well that could lead to some of this. Interestingly, we did look back into 2016 in the last election when Trump was elected, And we did see right after the election a pretty large spike in rates. And then we kind of lived in this 5 to 6% range for most of his term until, COVID hit. And then we saw rates that we'll probably never see again in our lifetime.
So you're hoping for another pandemic?
I don't want to spend that much time in my house again. So maybe not another pandemic. If we can go outside and see people, it might be great. But,
Listen, at this point, 5 or 6% sounds fine.
5 or 6% sounds great, right? And I think,
and that's where we were headed. I mean, we were at 6.11% in the middle of September.
Yeah.
Here we are 2 months later, and we're 0.9 of a point higher.
Right. We got the headline everybody wanted, which was the Fed cut rates by 50 bips, but then mortgage rates went. That's a fun conversation to have with a client, right? Hey, well, I see the Fed cut rates by 50 bips. Why is my rate going up? Well, unfortunately, right?
There's
as you guys talk about all the time, right?
Play, yeah.
The 10-year Treasury, and I think right now that's what we're seeing, right? The 10-year Treasury, there's been a sell-off. The yield is rising because people are betting on the economy right now, even though some of the measures that Trump has talked about in his campaign are very inflationary. The idea is, or expectation is, that the economy is going to do well. So people don't want to be in bonds; they want to be in the stock market, and that's what's driving that rate up higher.
So what? A few questions to the degree. And again, I know that you don't have your crystal ball with you, but tomorrow I think is jobs report, and we have the FOMC meeting in a couple of weeks' time. What do you see happening as a result of jobs report? What do you see happening with the FOMC? And where do you see rates headed in the new year?
Yeah, so I mean, like the weathermen, we all try to predict rates, and we're always wrong. The expectation, earlier this year was that by the end of 2025, we would have seen fives again. That's been revised recently by Fannie Mae and Freddie Mac. They are forecasting low sixes by the end of 2025. But again, I think it's really to be seen, and all we can count on is that there's going to be volatility till we get there.
Okay. Let's just set aside Freddie and Fannie and all of that. So let's start with FOMC. What happens with the Federal Open Markets Committee in the month of December? Do you think that there's going to be another cut in rates, or do you think that Jerome Powell is going to encourage his members to just keep rates where they are?
I think they're going to be in a wait and see.
Yeah,
I think they're going to be. I mean, again, depending on what happens with the jobs report, it'll be interesting to see. Obviously, we saw the jobs reports earlier this year all get revised down. Mm-hmm. Do we see actual numbers this time?
Sure.
Or do we see the revisions come back that a month later? And again, maybe there was a motive behind making the numbers look better than they were, or maybe there wasn't. But it depends on which side of the table you're on, I think. And if we can see some real numbers and not see the revisions, and the real numbers are weaker, then I think we see a cut. But if the numbers come in and they're kind of where everybody was expected them to be, I think they hold steady.
Did Jerome Powell just last week state publicly that he's not in any rush to make any further downward revisions?
That's I think that cautiously they want to take a wait and see approach.
Well, yeah, I think that's what it comes down to, is we need to see what's going to happen. It's just, I guess what's been frustrating through this whole process is that, I've said this before, but seemingly the rules of the game just keep changing on us, right? Yeah. For how long, Mark, were we just locked in on the jobs report, what the FOMC was saying, CPI, yep. All that was really important data. And then all that seems to go favorably. And then suddenly like Charlie Brown, the football's pulled away, and now we're focused on other issues that are keeping these rates higher.
I like the timely reference.
Yeah, I mean,
it's a Charlie Brown
classic,
right?
Yes. It is timely, indeed. Yeah.
So,
although I gotta say that the Charlie Brown Thanksgiving special is probably my least favorite of the three.
Really?
Halloween, yeah. Come on, okay. Christmas, absolutely number one. Followed by Halloween.
Halloween's pretty good. The Great Pumpkin, obviously.
The Great Pumpkin, yes.
Absolutely. Yeah. And then Thanksgiving, I can do without it. But I digress. You're on.
From your perspective, what have your clients been saying to you and your lenders about just how chaotic things are? Because it's tough to get a read on what's been happening, what's going to even happen.
Yeah, I mean, I think the toughest part was when rates were in the low sixes. We pre-qualified a bunch of borrowers. Now we're having to have those conversations. Hey, you know what? Rates are now 1% higher. Either the house you were pre-qualified for you can no longer afford, or it's going to cost you X amount more per month if you still want to get into that house. So I think that, we always talk about, timing is everything. I hear you guys talk about it as well, right? And when you look back 2 years ago or a year ago when rates were at their highest in the eights, those people that said, you know what, I'm taking a break, I'm going to pause. Well, now if you're coming back this year, even though rates are 1% lower, you're paying more for the house, right? And so
Yeah,
what is
right.
that?
Yes.
That timing is always key. And I think if you're in the market to buy, if you really want to buy, buy now, right? And you can always refinance later. We have, and many of the banks locally have some great products where if you buy with them now, when you come back to do your refinance, we'll waive some fees so that it's a cheaper refinance for you. Because we know that, and we rolled that out about the beginning of 2023, knowing where rates were going and that they were at this heightened level to give people comfort to say, I think you guys coined it, right? Date the rate, marry the house.
Sure, yeah.
I think you guys have killed that saying. But that idea of, just, hey, we'll help you out on the refi because you want to get into the house now and make that investment.
Now that you mentioned that phrase, there was some criticism of it because people were misinterpreting, I think, at least what we were intending. There may have been others that weren't necessarily putting it out this way, but people buying a house that they could only afford if rates came down. Which is never what we've been saying.
No, not at all.
Our whole thing is always make sure it's something you can afford. But if you're able to refinance 2-3 years down the road for a lower rate, that's fantastic. How many actual instances have you seen clients find themselves in that situation where they purchased something that was really a stretch and now they're hurting because they haven't had the lower rate they were expecting?
Yeah, locally we haven't, for us, we haven't seen it a lot, right? And I think, and even if you look on the national scale, right, foreclosure rates are still at their lowest level. I think lenders now are more willing to work with borrowers should situations change, right? I think if you get into a house, it's very difficult to get into a house you can't afford at its current rates now because the guidelines are so strict. It's not like back in 08 and 09 when we were just, hey, write your income down on the napkin and that's how much you make and we'll give you the loan. And I think that's where a lot of people, you heard that a lot. Oh, the market's going to crash. The market's going to crash. And the house of cards is much sturdier now than it was back in 2008, 2009.
People are actually being qualified. They've got to actually show up at the closing table with actual cash.
Correct.
Appraisals.
Right.
Appraisals are, actually coming in at value.
Yep.
They were coming in just so wildly overvalued 15 years ago. It's
Absolutely.
insane. Yeah. I want to go back just a minute. What's happening when it is that you're telling these prospective buyers and you're qualifying them and saying, really, really sorry, but we qualified you when rates were at 6.11%. They're now over 7%. What's the reaction? What are you getting from people?
They're surprised, right? I think, they hear what's going on in the market. We try to keep them as informed as we can. But ultimately, it's a difference in payment. Now, depending on loan size, sometimes it can be $50 a month. Sometimes it can be $200 a month. It depends on how large of a loan they're buying. But, there are tools where, they can pay points to buy that interest rate back down. We have a temporary buy down product that we actually fund as the lender, where for the first year of their mortgage, their payment can be based on a rate that's 1% lower than what their actual rate is. So it gives them some of that reprieve. So if they were planning on, hey, I'm going to hold 2 houses for a little bit, it helps them to take a little bit lower payment. And we fund that buy down account ourselves out of the loan. So it's not coming out of their pocket.
Well, this is... Banking has always been a very, very staid sort of, boring. This is the way that you do it. We've done it this way for decades on end. But the market has changed. The mortgages in particular has changed so dramatically. You really have to pivot much more quickly than I think the industry is used to in order to be competitive with the competition that you got.
Yeah, I've been in the business for 20 years, and I've definitely stood on my head a lot more this last year than I have in the past. Right? It's been an ever-changing dynamic that we've just constantly having to navigate through, and being able to just look at a loan and say, hey, you know what, this loan doesn't work this way, but if we do X, Y, and Z, we can still make it work. And that, that's ultimately, if you don't have that skill set in your bag of tricks right now, you're losing a lot of deals.
Well, not only do you have to have the skill set that you described, but you also have to have more different and products that are more innovative.
It was so long for 3 years. It was, here's your 30-year or 15-year conventional, and that's pretty much all you're shelling out, right?
We had to retrain staff on how to overcome rate objections, because for a long time it was, here's 3%. Oh, sure. Where do I sign up, right?
Yeah.
And so, just getting back to the basics. And I think, we've seen that as well with you guys. It seems like you're back to being more realtors, right? More negotiating than you were doing for the past couple of years. More trying to structure deals in ways that are going to work versus putting the property on the market and getting, 80 offers.
Yes, I mean this is really, back to the old Warren Buffett phrase about when the tide goes out, you get to see who's been swimming naked. You've got all of these agents who just don't know how to sell real estate. They don't know what it's like to actually work in this industry during difficult times, and it's been difficult. It's been very, very difficult. So so we as realtors have had to change, but the banking industry in particular has changed dramatically. And by the way, we haven't said this explicitly or overtly, but like we've got to just call out GRB as being just such great partners to us, and you're there on our behalf and on behalf of our clients. It doesn't matter whether we call Melissa at 9 o'clock on a Saturday morning, Wednesday night at 10 o'clock, and she's there, and you guys are there, and you back us up, and our clients benefit as a result of all the hard work that you do on behalf of the buyers that we're working with. So thank you very, very much.
Yeah, we appreciate the partnership, and you mentioned the pies. It's funny to see. I think we've been partnering on this for a few years now, right, with the pies, and every year I hear you guys talk about it, right, and it's a great touch to just something nice, a nice gesture to let people know you're thinking about them, and it is a great to see that partnership. And I think that's one of the things that we've done more this year than we have in the past few years, is really partnering with our agents like yourselves to work through transactions, right? Because I think that relationship is so important. If you can pick up the phone and say, hey, Mark, you know what, this deal's going a little sideways, but we need a day or two to get it closed because something happened with the customer, and we're able to just navigate through that and work together to make those deals happen.
And Corey, I'm sure that you've had this experience often. You've got a client, buyer or seller, and they're flipping out about the fact that the mortgage commitment hasn't come through on the day that it was expected, or something that's just gone a little bit. I mean, first of all, it almost never happens with you guys, but we're able to pick up the phone, call our client, and say, "Don't worry, it's GRB. I've just spoken to Joe. I've just spoken to Melissa, and everything is going to be perfectly fine." Because and I think our clients take comfort in the seriousness with which, and the certainty with which we're able to convey that message. So again, much gratitude.
When we're meeting with specifically new buyers, that's why we're always recommending to work with GRB, because we know we can do that, and we know it's not going to be getting a 1-800 number where we're stuck endlessly in press pound and all that to actually speak to a person. We just go straight to the source. So it is very helpful.
Yeah, absolutely.
Go ahead.
So let's look ahead a little bit. We're going to crystal ball as best we can. For the market in general, what are your expectations for 2025?
Yeah, so from our vantage point, I mean, we're expecting a lot of the same, right? I think you guys see it on the forefront. A lot of the deals that we see on the backside is, hey, it's death, divorce, kind of despair situations where people are selling their homes. And unfortunately, we've been in this inventory rut for how long? And we talk to and pull roughly 420 to 450 credits a month. Meaning we're talking to 420 to 450 people that want to buy a house. You guys go through the numbers. That's not even possible.
That's right? All the homes in the market right now.
That's right. That in 1 month, we're talking to that many people that want to buy a house. So it's the buyer demand is still very strong. It's still there. It is slow right now. I think you guys are kind of feeling it a little bit as well. It does seem like a good time if you're a buyer to want to go out and buy a house right now, because there's opportunity. But we saw last January, it was nuts. I mean, it was like everybody made a New Year's resolution that they wanted to come out and buy a house, because I think we pulled over 500 credits last January. Wow. And then it just kept going throughout the year. And we were like, okay, at some point it's gonna tail off. It just tailed off this month.
Oh, wow.
Right? So,
okay.
It's been a pretty steady year from a demand perspective.
I'm predicting, we already know where the first $10 to $12 million worth of listings are coming from. So in January and February, we're listing between $10 and $12 million worth of real estate. So we're going to have the product, hopefully. Well, I think the buyers are going to be there.
The buyers will be there. Yeah.
Well, from an inventory standpoint, what I'm wondering is happening, because it seems like, again, we're prepping for a bigger year, at least for our brokerage in terms of the listings that are out there. Is that there's going to be more listings in general, or is it that the bigger groups are eating up more of the market share? Because we have seen a pretty large increase in market share this year.
Yep.
I think it's both.
Yeah.
I think that the the more successful the agent, the more successful the team, the more market share they're going to enjoy. But I also think we are just a bellwether of what is coming down the pike. So 3-4 months from now, I think what we're experiencing now in terms of our ability to forecast, I think it's going to come true. There's going to be a lot of product out there. Do you want to weigh in?
Yeah, I mean, I do think, and I've been saying this for a while, maybe it'll come true this year. At some point, consumer behavior takes over, right? I think at some point somebody's going to say, yeah, you know what, I got this great 3%, but my kids are sharing a bedroom. I want to remodel my kitchen, or I could go buy a house that has a remodeled kitchen, or I want to put in a pool, or I could go buy a house that has a pool. And I think at a certain point, consumer behavior does come into play where it's like, okay, you know what? I can cash out the equity in my house, go buy this house. My payments are going to stay close to the same, and I can make that move up that I've been hesitant to make for the last few years.
Yeah, I think whether or not Trump and his policies are inflationary, and I do think they're inflationary. I think that inflation is going to take off again, but perception and psychology are so important in terms of consumer behavior. And everybody thinks that the economy under Trump is just going to be, people are just going to go hog wild, I think, over the course of the next 6-9 months.
Right. Well, and we saw it with the COVID money that was out there, right? For people were spending money like crazy. And if some of these tariffs versus income tax and, whatever those policies may be, if it puts more money in the consumer's pocket, they're going to spend it.
Yeah. Agreed.
I want to go back a little bit. You brought up the amount of people that are reaching out. It's a lot of, at least for sellers, death, divorce, that sort of thing. Are you seeing more people who have mortgages with you right now that are reaching out to make that next step? Because that's kind of been the missing link the past few years of the people that have their starter home or their second home who are, should be on track for that third or fourth home who are just kind of stuck. Are you seeing that open up at all, or still not really? Not
really. We've seen it in pockets. I think where the challenge lies with that is you need that draw. Right now, a nice house comes on the market and it's off the market in a week. But if you see, hey, you know what, this house has been sitting for a while. It's got a nice in-ground pool and it's got an extra bedroom. Let's go look at it. I mean, I actually in 2019 we were living in a 4-bedroom house. We wanted to move to a different part of town, right? And so we saw this house. It had been sitting on the market because they were doing new construction, and we weren't even looking for a house. You know what? Let's go look at it. It's where we want to be.
Yep.
And we looked at it, kind of hemmed and hawed, and said, you know what? Let's do it. Let's buy it, right? And so ultimately, but had that house not been sitting, I would have never bought it. I would have never moved, right? But it's that idea that inventory is flying so quickly that those people that kind of maybe on the fence need that extra little nudge. And until they can see something that's going to give them that nudge, I think that's when we'll start to see some more of those buyers kind of
more opportunity-based versus the plan is we're definitely doing this.
Right.
Interesting.
Tell me about Jerome Powell.
Oh, boy.
Do you think there's going to be any attempt on the part of the incoming president to dislodge him as chair of the Federal Reserve?
Or bully.
Or bully. Or do you think it would just create such hysteria and so many problems for world financial markets?
I actually was thinking about this the other day, and I'm trying to. Normally, when a new president comes in, they name their own Fed chair, I believe.
I think they wait until the term of the existing chair expires.
Okay.
So I think that Jerome Powell is instilled and in place until, is it March or May of 2026? So he's got another year.
So he's got another year and a half.
Yeah.
So I mean, I think that if, as we saw in the past, right, when President Trump didn't get his way, right, he just got rid of people or managed them out or moved them out and got the people in there. And I think I don't expect anything different. I don't know if you do, but I do think that there's going to be an attempt to get him to step aside so he can put who he wants in there.
Wow. Okay. I think that.
So pure speculation, right? I mean, this is just.
I think that the chaos that would ensue. Because the concern on the part of bankers, economists, and others, at least from my perspective and what it is that I'm reading, is that there needs to be the independence. There needs to be a clear division between the Oval Office and the Federal Reserve. And it is part of the mandate, the charter, when the Federal Reserve was created back in the 1930s. And you don't want a Federal Reserve chair who's beholden to the political whims of whomever it is that's occupying the Oval Office. So I think that everybody would be just terrified of Jerome Powell being pushed aside. And by the way, he says that he's not
right.
leaving.
He's not moving. Yeah, he did say that.
So any attempt, I think, would be seen by world financial markets as an opportunity for politics to really begin to dictate federal policy, federal monetary policy, federal economic policy. And I would be shocked if it happened. And I pray to God that it doesn't, because I think that would be really bad.
I think there's been a lot of work to get us to where we are today. And I think if you do interrupt that work, right, and you make a dynamic change, it is going to throw chaos.
Yeah.
But do either of you think that stops Trump from trying?
No.
Of course not.
It'll be interesting. It'll be interesting to see if he does try, whether or not he does so overtly, or whether or not it's some covert sub rosa attempt that's all playing out behind the scenes.
So far, it seems like everything's been pretty on board, above the table.
Yeah. But again, well,
I do think the other piece to watch is the CFPB, right? I think,
yes.
We saw under
for
the
those who don't know, you might want to explain.
The Consumer Financial Protection Bureau, the head of that bureau, they're responsible for basically regulating the mortgage space, any credit cards space, anything consumer related. And, depending on who's president, the Democrats typically take a more aggressive approach to that regulation. Whereas when Trump was president last, there was not a lot going on. I mean, we've definitely felt it on the mortgage side of things over the last 4 years. There hasn't been new regulations, but the scrutiny has been there. It's been stronger than it was in the previous 4 years. So I think that piece is going to be an important piece to watch, because I do know that they're trying to cap credit card interest rates and so forth, which I think is probably actually a good thing. But that CFPB does come into play, and who's going to regulate it, and what type of restrictions are they going to put down?
There's definitely going to be some shakeup. No two ways about it.
Yeah.
I'm sure that. Well, I mean, Matt Gaetz may very well find himself, no longer the Attorney General of the United States. So, perhaps that's a role for Matt Gaetz to play.
Find him something else. Let's pivot here. We haven't talked technology yet. How is it possible? We've gone this long in the podcast. We haven't talked AI.
Yeah.
We haven't talked tech. What's the latest in the mortgage industry?
You're seeing a lot. We are seeing a lot, actually, of people trying to come into the space to create more efficiencies. You've seen, the Rocket Mortgage click button, get mortgage, right? But we're starting to see some of that reality come into play. Can you use OCR technology, which is basically technology that reads documents, to underwrite a loan, right? And how quickly can we adopt that type of technology so that in 30 minutes you could have a fully underwritten mortgage approval?
Versus how long does it normally take?
Normally, because of the human interaction and everything, right? You're talking about, for initial mortgage approval, 7 days, right? So, can you cut that back? Can you allow your underwriters to spend time on other things? This is actually a conversation we're having right now at the bank, at looking at some of this technology, because we think that it can help us to scale without having to add bodies. And unfortunately, what you've seen in the mortgage industry so much over the last 10 years has been, refi boom, let's hire 100 people. And then, rates,
right.
Business is bad, let's fire 100 people, right?
Yeah.
And we've never been in that cycle here, because we're local and we try to plan it. But, you see it, it's an industry problem. And, unfortunately, you're messing with people's lives, right? You're, hey, have a job for 2 years, and then we're going to lay you off, and then have a job. I mean, I went through it myself back in 2015. I worked for Chase down at the tower, and they said, we sold the building and we cut 350 people. Right. And then it was like, okay, go find a job. And then luckily I landed at GRB, and, the rest is history. But, you have seen that cycle of up and down. So the AI is coming to try and alleviate some of that cycle. So I think there are some big things to come. I think appraisals, we are starting to see more push from Fannie Mae and Freddie Mac on what properties qualify for a property inspection waiver now. And they've changed some of those loan to value restrictions. Before, it was a certain loan to value, I think it was 80% or under would qualify. Now they're going up to 90.
And I'm going to just jump in, right? It's a bit esoteric what you're talking about. Can you just lay that out for those who might be listening who don't quite understand all
Yeah,
that?
So typically every home requires an appraisal when you go under contract. And then there's certain instances where Fannie Mae and Freddie Mac will say, hey, you know what? We had an appraisal on this property from 2 years ago. We have enough data. We're comfortable that this value is supported. And so what they'll do is they'll give this property inspection waiver, meaning you no longer need an appraisal. And so there's certain characteristics. If you're putting 20% down on the home, you could qualify for that property inspection waiver or not need that appraisal. They've just shifted that to 10% down.
Wow.
So, it's not every instance, but if they have the data readily available, they'll issue that waiver saying, hey, we're comfortable that this house is worth what it is. We are starting to see more of that come in, particularly on the refinances too. When we saw a few refinances come through when rates were down, we saw that those borrowers were receiving those waivers because they just did a mortgage a year ago. So they had the data on the property.
But is that a national blanket or is there regional variance? Because, think about Florida, for instance. Somebody paid $300,000 2 years ago.
Yeah, the algorithm definitely looks at, is this a declining market? Is it an increasing market?
Great.
What do we have? Yeah, definitely there's an algorithm behind the scene that kind of picks it all up. But we are seeing more of that, and I think you're going to see more of that. I think because of the challenges that we've had with just the appraiser industry in general, right? It's an aging population of appraisers, and you need quite a bit of training to get in. So we don't have that issue locally, but there's rural parts of the country where it takes 3 weeks to get an appraisal back.
Wow.
Because they just can't there's not enough appraisers up there to do the work.
Wow.
So.
All right, I'm going to just go down the technological path for just a moment. Personally, what do you use? Do you like technology? Do you personally embrace technology? And what are your favorite current AIs or technology?
So I will say I do like technology. I use ChatGPT, probably not as often as I should, but I do use it. I think it's helpful to really just kind of get some quick insights into things, maybe an email edit, et cetera. But I don't use it to the extent. I know I've heard you talk about how much you use it, but I have seen some cool things with just using it for things like building your own brand statement. There's different cues you can give to it to help build that. Have you seen it used in training, right? And role playing with, as if you're a customer and you're trying to convince this customer to list their home with you. You can feed it the how difficult you want the customer to be and actually role play some of the conversation.
Well, that's interesting. I haven't even thought about that. Yeah.
So I'm just counting here. There were 12 different topics throughout the course of the day yesterday that I approached ChatGPT about, and like these, like in depth. I just came back from Mexico. I love going to a foreign country, and I love being. And after I'm there for like 7 or 8 days, like the language starts to come back to me. I become a little more. Well, I'd like to keep up on it, so now I'm asking ChatGPT in the morning or at night. Can you tell me a story, no more than 5 sentences long, in Spanish?
Just to hear it.
But please speak to me slowly. And then I'll ask you to repeat it again and again and again because I'm trying to learn the language. It's so great. Yesterday, I've got a new mailing that's going out tomorrow with 5 different bullet points. Wrote that up, but I had a stressful day. I was like, hey, would you do me a favor? Could you just walk me through like a meditation exercise or a breathing exercise for like no more than a minute and a half? It walked me through this.
Wow,
that's great.
It doesn't anything that I need or want. It's just insane.
Yeah. You speak of traveling. I was in a workshop recently where the woman was speaking. She said, my husband and I were going to Switzerland, and I asked ChatGPT to plan my trip for me.
Oh yeah.
And then she said, as I got more specific and more specific and more specific, it basically built their whole itinerary for them.
Absolutely.
We want to rest in the morning and go out in the afternoon. We're going to be here on this day and what's popular. And
packing list, I'm leaving in 25 minutes. I need a packing list. I'm going to this destination. I'll be, and then it just asks a series of questions. Will you be having any business dinners? Do you need any, suit coats? Do you need any dress shoes? Yeah. Anyway, any other AIs that you love?
No, that's really it. That's the extent of my AI so far. Okay. If I get this automated underwriting thing through, I think that will be my
the new favorite.
That will be my new favorite.
I was just having dinner with Todd Baxter, the sheriff. They've got a new lab downtown that allows the techs to actually break into cell phones or iPads, and it's just a technology lab so I'm going to get a tour of that sometime in the next few weeks, and I can't.
It's going to geek out.
Can't wait. I'm probably going to leave my job as a real estate agent. Yeah. So anyway.
Anything else that you wanted to ask Joe?
One really, and I'll ask you to just dumb it down but there is some conversation about Freddie Mac and Fannie Mae being privatized. Do you want to weigh in on that, or?
That's one where I think my guess is as good as yours,
okay.
Right? I think, it's interesting that, we've had this for years, and I don't know the demand for the mortgage-backed securities, right? I think that's always been part of the issue is if you do go back and privatize Fannie Mae and Freddie Mac, where's that demand going to come from? and that would have a very big impact on rates. And honestly, I think that's why they haven't done it, because I think if they know that demand goes away for the mortgage-backed securities, what's that going to do to rates, and what's that going to do to the overall economy?
Right. Oh, actually, I do have one more question. Tell me about the spread. What
all right.
is going to go on with the spread, for God's sake? And could you describe or define what I mean by the spread?
Yeah, so as you guys have talked about, there's a spread between the 10-year Treasury and the mortgage interest rates. And historically, that spread has been about 180 basis points, meaning that if the Treasury is at 4, mortgage rates would be at 5.75, 5.8.
So meaning that you as a bank get to borrow the money from the Fed at 4%, you then turn around and you issue a mortgage to somebody or loan the money at 4.8%. That 1.8% that is in between is the money that is more or less profit for the bank.
Well, yes and no. So that spread is more based on where the 10-year Treasuries are at and where mortgage rates get set.
Okay.
So, that's when you see that if that spread's 180 basis points, if the 10-year goes up to 4.10, rates are going to 5.9. If it goes down to 3.9, right, et cetera. So that historically has been at 180 basis points. Over the last couple of years, that's gotten as high as 300 basis points. And I actually raised this question to an economist last year, and they had no rhyme or reason to it, other than the expectation was at the time that the mortgages were going to pay off. So to make those mortgage-backed securities more attractive to the end investors, they created more of a spread, because the expectation was, okay, you're making more money in the short term because that loan's going to pay off quicker because people would refinance down into a lower rate. So that, I think, has started to shrink a little bit. I think it depends on, again, with all this volatility, and is there a demand for mortgage-backed securities that comes back to drive that spread back down? There's a lot there that we covered.
A lot we don't know, unfortunately.
Right. And there's a lot that we need a crystal ball that we don't have.
Right.
In short, it sounds, if I can summarize, it sounds as if nobody knows where interest rates and mortgage rates in particular are going next year. B, it doesn't sound as if they're going to be dropping, that we're not going to be enjoying a 5 handle anytime too soon.
No, I would be surprised if we, by end of next year, if we saw, I think low 6s, I think we get there 5s. I think I was more optimistic about 5s 2 months ago when we were in the low 6s, right? I think we actually saw some 5s with a little bit of points. But now that we've come back to the 7, but again, nobody expected rates to drop when they did, right? There was really no rhyme or reason for rates to go back down to 6.
Well, it was anticipation.
Yeah.
People assuming that the Fed was going to drop by 50 basis points, and that happened. But then as soon as it happened, then people started thinking, oh, Jesus, it looks as if Donald Trump is going to win,
right.
And that's going to mean inflation. So there's just a lot of uncertainty. I think the only, and we've said this through the years, I think the only that we would advise our clients and others who might be listening is that this isn't going to get easier anytime too soon. There's not going to be any inventory anytime in the near future. There's not going to be interest rates below 6% anytime in the near future.
Prices aren't going down.
Prices are not going to go down. So really, if somebody's interested in purchasing a house, they should just go ahead and do so. Roll up their sleeves and just buy a house and hope that you'll be able to actually refinance at some point in time in the future. I mean, yeah, I think that's a fair summary of where it is that we are.
Yeah, I mean, and we saw it, right? We saw it year over year. Prices keep going up, and rates go up and down, but there's never there's never going to be that perfect time, I think. It's like you said, to your point, right? Can you afford it? Is it within your means? And you can always get a lower payment later on if you can afford the payment at the higher rate now.
Yeah, if it's a pleasant surprise, great. Don't expect it, but it's possible. All right. Well, Joe, thank you so much. Appreciate it.
Yeah, thank you guys. And probably won't see you before then, so hopefully you guys both have a good Thanksgiving.
Oh, thank you very much.
Enjoy the holiday.
Oh, I just have one question. Go-to for Thanksgiving. I mean, I'm a purist. I go turkey, mashed potatoes, stuffing, gravy. That's pretty much it. Really? I don't want the cranberry sauce. Really? I don't need all the extra stuff. It's the basics.
Really?
It's real estate, Mark. There's only so much room on the plate and in my stomach.
Yeah, but there's more than one plate. I'm just suggesting. Joe, your go-to?
So I'm stuffing and sweet potatoes. Those are my two go-tos. Also, I mean, our Thanksgiving is a little different. It's an Italian household. We probably have a pie for every person in the home that's there, and usually we're about 35 people. So there's a lot of food and a lot of desserts.
Well, come on, but there's also there's got to be pasta.
It's actually a version of Italian wedding soup.
Okay.
It's chicken soup with little meatballs in it that my mom has made historically. I can tell you a funny story about it another time. But it's we have that. We used to have lasagna. Now we do the Italian wedding soup, and then just a smorgasbord of food. More food than anybody could ever eat.
Yeah, that's the point, right?
Right.
Mark?
If it's sitting on the table, I'm going to, I like you see me eat. I'm like,
The napkins.
I'm a slob. I mean, exactly. I mean, like,
Mark, that's a candle.
Oh,
Put that
candle
down.
looks- exactly. That candle looks really delectable. So if it's on the table, I will inevitably consume it. Yeah.
Fair enough. All right. Joe, thanks again.
Thank
Enjoy
you,
your
guys.
Thanksgiving. And thank you so much for watching or for listening. We'll talk to you again next week.